Welcome to this How You Did in 2020 segment of Where To From Here. I'm Tom Bradley, Chair and Chief Investment Officer of Steadyhand, and I'm joined by my fellow portfolio manager, Salman Ahmed. The two of us are responsible for the Steadyhand funds, and today we're going to review how the funds, and by definition you, did in 2020. Now, it was a year for the ages. I think you all know that. It had a bit of everything in it. It started with rising markets, smiles on investors' faces, maybe even a little greed creeping into the equation. But sandwiched in there in March was a jolting, lightning-fast bear market that took us all by surprise. And bear markets, for those of you who don't remember, are defined by declines in the stock market of more than 20%. And we had that and more in March. Now, when I reflect back on that period, I think there was about a week or 10-day period where, I think the panic was as bad as anything I've seen in my 37 years of doing this. But after all of that added together, it came out to be a pretty good year. And if you look at these returns on the major asset classes, you can see that. So keep these numbers in mind, keep my comments in mind, and I'm going to turn it over to Salman to dig in a little more on to how we did and put a little color on that.
Thanks, Tom. As Tom mentioned, I'm going to take you through how your portfolio did in this unique environment. And to do that, I'll use the Founders Fund. The Founders Fund is our most popular fund, and it's a good reflection of our average client's experience. The fund is a balanced fund that invests 60% in stocks and 40% in fixed income. And it gets to that mix by investing across our lineup of funds. It's what's known as the fund of funds. Now in 2020, the Founders Fund returned 8.5% after fees. That puts it in the top quartile of Canadian balanced funds for the year. And keep in mind, your returns might be better because you might be taking advantage of our fee discounts, which you receive by virtue of the size of your commitment at Steadyhand and how long you've been a client. But that 8.5% return hides what clients went through to get there. At the end of the first quarter of 2020, the Founders Fund was down almost 13% after fees. Through this period, the market experienced that steep bear market, that sharp bear market that Tom just referenced. Stock markets around the world were down 20 to 30%. Now, the Founders Fund wasn't down as much because, as I mentioned, it owns fixed income. And when stocks fall, fixed income like bonds and cash tend to hold their value and even rise, which is what happened in the case of the Founders Fund. Now, by the end of the third quarter, the fund had returned to being back in the positive. And the reason for that is this huge rebound the stock markets around the world experience. In fact, this period has gone down as one of the fastest rebounds in history. And once again, we were seeing those examples of investor greed. The recovery was uneven, and you can see that in the dispersion of return within our own funds. Two of our funds, our income fund and our equity fund, were doing very well. The income fund owns those fixed income securities, specifically bonds that I talked about earlier, that had done very well as the stocks were declining. But our equity fund was gaining because it had exposure to those two areas of the market that had done best over the previous 9 months: technology and precious metals. Companies like Franco-Nevada. Franco-Nevada was one of the best performers last year. It is a royalty company and allows miners to dig gold and other precious metals on its land. The equity fund also held Microsoft, which I think we all know, but the company saw the surge in demand last year because everyone went virtual. But most other industries were reeling, and you can see that in the performance of our global equity fund and small cap equity fund in particular. They were holding consumer companies, financial companies, and even some industrials. And I guess it's somewhat ironic in hindsight, but the reason they were holding companies in these industries is because historically, these areas have been defensive. They tend to hold up during an economic downturn. But as we learned in a pandemic and an economic shutdown, they didn't do too well. Our Builders Fund was down 5% as well. As a reminder, the Builders Fund is a more growth-oriented version of a fund of funds. It's like the Founders Fund, but it invests exclusively in our 4 stock funds, 3 of which you saw were still in negative territory. But things changed dramatically in the fourth quarter of the year. Both the Founders Fund and the Builders Fund saw a surge in performance in the last 3 months. And it was no longer the income fund and equity fund that were leading the charge. In fact, it was those funds that were lagging for most of the year that were now seeing double-digit returns. In the global equity fund, aerospace holdings did particularly well. They had been purchased by our manager, Valan, earlier in the year when the market downturn was at its worst and saw a major rebound in the last few months. In our small cap equity fund, a company like Interfor gained 50%. Interfor is a lumber producer. It sees a recovery when there's better signs for the economy because it sells lumber to housing developers. Overall for 2020, that meant positive returns for most of our funds. I already mentioned that the Founders Fund had top quartile performance, and even the Builder Fund ended up with 6.9% for the year. Those returns came on the back of great returns from our income fund and our equity fund, and also a great finish to the year from our other funds. The other point that this table helps illustrate is the importance of sticking to your plan. And I know that's a cliche and you're tired of us saying that, but its importance was on display in 2020 and something we're really proud of helping our clients with throughout the year. We remained accessible through 2020, and many of you reached out to us, especially during those turbulent times in February and March. And after those conversations, by and large, you stuck with it. You didn't bail on that plan. You didn't go all cash or change your portfolio to become more defensive if the idea was to be balanced or have a more growth-oriented portfolio. Had you changed course, you would not have experienced what in the end was a great calendar year return for Steadyhand clients. Now that was 2020. I'm now going to pass it back to Tom, who will take us through longer term numbers and some of our thinking going forward.
Yes, Salman. I'm going to pull back and take a longer term perspective, 10 years in fact. Now I'm using a simulated portfolio here, one we've kept track of since we started, because the Founders Fund is not quite 9 years old. What this chart says is if a Steadyhand client had had a 60-40 asset mix and stuck to it over 10 years, they'd have an average annual return of 7%. Now that's before any fee reductions, and clearly a 10-year client would have some of those. But in that time period, they would have roughly doubled their money. Now we haven't seen the final industry stats, but we're led to believe that this will show very well versus our competitors. Salman finished his comments by talking about sticking to a plan. And I think 2020, more than most other years, reinforced those vesting principles that we talk and write about all the time. And maybe reinforced is the wrong word. It kind of hammered them into our head. So here's a few to think about just as I bring this segment to a close. First of all, if you're going to stick to a plan, you got to have one. You really need to have a roadmap to fall back on because this is a long, bumpy journey. It's a rewarding one, but nonetheless bumpy along the way. We know that stocks will overreact to the daily news. That certainly happened last year, and it's something we can count on happening going forward. And therefore, we need to know what we're going to do when our portfolio takes a dip because of the stock market. Now, that's such an important principle because the next principle is that when you make major decisions in your portfolio at market extremes, it rarely works out very well. And I feel for the many, many Canadians who made big decisions in March of last year. Now, we also learned that when investors are fearful, it's a less risky time to invest. We talk about this investment sentiment all the time. And why is that? Well, the risks are all out on the table. There's nothing being hidden or tucked away under the rug. We always say this. I know it's a broken record, but always be diversified. You don't know what part of your portfolio is going to do the pulling at any one time, and you want to have your bases covered. And finally, I think a really good one to finish on, portfolios go through good and bad periods. And when you add them together, they create a trend up and to the right, as long as you let them. So we're going to bring this segment to a close. I hope you'll watch some of the other ones. Thanks so much for watching.